What if the friends had invested their cigarette money in the stock market index fund during their lifetimes? How much would it have been worth? Nearly $100,000. And what if they had used their cigarette money to purchase shares in a tobacco company? What if they had purchased, reinvested all dividends, and never sold shares in Philip Morris instead of smoking Philip Morris products for 46 years? At the end of 46 years, the couple would have had a tobacco portfolio worth over $2 million. But the couple, like their son, never imagined that small change could be transformed into significant wealth. This change in behavior alone would have placed the friends in the millionaire category. They would have been members of the PW group, too, given their modest income. Perhaps they would have lived differently if someone had educated them about the mathematics of wealth appreciation. No one told them about this phenomenon. So it is not surprising that they failed to educate their son about the benefits of investing. But they did tell him not to smoke. His dad told him, "Don't ever put the first cigarette in your mouth." "I'm hooked. There is nothing I can do to quit." His son followed this advice, kicking the UAW habit. How long will Mr. Friend be able to fund his lifestyle? What if he were to stop working today? How long could he live off his current level of wealth? Only for about a year. No wonder he works so hard. Given his current circumstances, Mr. Friend will never be able to retire in comfort. In spite of being nearly 50 years of age, he is yet to figure this out for himself. But all is not hopeless. Mr. Friend can still become an accumulator of wealth. We find that it is often useful for UAWs to be told the naked truth. "Friend, you're worth less than one-half of the expected amount for those in your income-age group." Such news can spur on UAWs who are competitive. How do they respond when told that their net worth places them in the bottom quartile for all people with similar income and age characteristics? Some are incredulous. Many want to change but are uncertain how to transform themselves. How can someone change when they have more than 20 years' experience as a UAW? First, they must really want to change. Second, they will likely need some professional help. Ideally, they need to find a certified public accountant who provides financial planning. A professional of this type should have considerable experience and success with transform ing UAWs. That is, they should have a strong track record in helping the Mr. Friends of the world become more PW-like. In extreme cases, a CPN financial planner actually takes control of his client's purchasing behavior. He first audits the client's consumption habits over the past 2 years. He categorizes and tabulates each element. Then the accountant consults with the client. The client is put into a cold turkey cutback program, meaning that all elements of consumption are reduced by a minimum of 15% for the next year or two. Additional cutbacks follow. In some situations, the accountant financial planner even keeps his client's checkbooks, writes all the checks, and pays all the bills. Cold turkey is not easy for most UAWs, but sometimes it's the only way to solve the problem. The ultimate CONSUMPTION category. The typical millionaire in our surveys has a total annual realized income of less than 7% of his wealth. This means that less than 7% of his wealth is subject to some form of income tax, asterisk. In our latest study of millionaires, the percentage was found to be 6.7%. Millionaires know that the more they spend, the more income they must realize. The more they realize, the more they must allocate for income taxes. So millionaires and those who will likely become affluent in the future adhere to an important rule. To build wealth, minimize your realized, taxable income and maximize your unrealized income. Wealth/capital appreciation without a cash flow. Income tax is the single largest annual expenditure for most households. It is tax on income, not on wealth and not on the appreciation. of wealth if this appreciation is not realized, that is, if it does not generate a cash flow. What is the message? Even many high-income producing households are asset poor. One reason is that they maximize their realized incomes, often to support high-consumption lifestyles. Such people might wish to ask themselves a simple question: could I live on the equivalent of 6.7% of my wealth? It takes much discipline to become affluent. We have interviewed many people worth $2 or $3 million who have total realized annual household incomes of less than $80,000. How much does the typical American household realize in income each year? About $35,000 to $40,000, or nearly the equivalent of 90% of its net worth. The result is that the typical household in America pays the equivalent of more than 10% of its wealth in income taxes each year. How about the millionaires whom we surveyed? On average, their annual income tax bill is an amount equal to only a bit over 2% of their wealth. That is one of the reasons they remain financially independent. Case study: Sharon Barber. Sharon is a high-income producing healthcare specialist. She recently asked us, how is it that I make so much in terms of income but accumulate so little in terms of wealth? Last year, Sharon's household had a realized total annual income of approximately $220,000, see Table 2.3, which places her household in the top 1% of all households in America. Sharon's household has a net worth of approximately $370,000, while Sharon's income is higher than 99% of the other households in America. Her net worth is far below what it should be. Given her age, 51, and her income, $220,000, Sharon should, according to the wealth equation, expected net worth equals 1/10 age x income, be worth approximately $1,122,000. Why is Sharon's level of accumulated wealth far below the norm? Because her realized, or taxable, income is too high. Last year she paid $69,440 in federal tax on her $220,000 income. This is the equivalent of 18.8% of her total wealth. Yogi Berra might say, Sharon, you can't be wealthy. Your income is too high. We believe that the average person in Sharon's income/age category pays the equivalent of only 6.2% of his wealth in annual federal tax, or $69,440 divided by $1,122,000. Thus, Sharon's tax equivalent, 18.8% of her wealth, is 3 times higher than the tax equivalent for the average person in her income/age category. To view this another way, Sharon has an annual realized income that is equivalent to 59.5% of her total net worth of $370,000. How could anyone hope to become truly wealthy when the equivalent of nearly 60% of her wealth is subject to income tax each year? The average person in Sharon's income/age category realizes the equivalent of only 19.6% of his net worth in annual income. Thus, only about $1 in $5 of his net worth is subject to income tax. What about people who have above-average levels of wealth? How much of their equivalent net worth is being taxed? Barbara is a typical member of the PW category. Her realized annual income is approximately the same as Sharon's $220,000. But Barbara's net worth is approximately $3,550,000. Therefore, the equivalent of only 6.2% of her wealth is subject to federal income tax. What percentage of Barbara's wealth is paid in federal income tax? Approximately 2%. In sharp contrast, Sharon paid the equivalent of 18.8% of her wealth in federal income tax, or more than 9 times the percentage for Barbara. The average American millionaire realizes significantly less than 10% of his net worth in annual income. In spite of having consider able wealth and substantial annual increases in wealth in unrealized form, the typical American millionaire may personally be cash poor. More than 20% of Barbara's annual realized income is invested in financial assets that tend to appreciate in value without generating realized income. Sharon, on the other hand, invests less than 3% of her realized income. Most of her financial assets are in liquid form. Sharon's economic situation is quite risky. She is the main breadwinner in her household, which has little investment income. If her employer eliminates her job, what then? There are not too many positions available today that pay $200,000 or more a year. Barbara, again in contrast to Sharon, has a business with more than 1,600 customers. That's 1,600 sources of income. This is much less risky than Sharon's position. Sharon could not survive for 6 months if she lost her source of income. But Barbara could easily survive for 20 or more years. Actually, she could retire at this point on the income from her financial assets alone. Barbara, the prodigious accumulator of wealth, is just one of more than 3.5 million millionaires in America today. More than 90% have a net worth between $1 million and $10 million. How do these affluent people compare with the super-affluent? Indications are that the higher one's net worth, the better one is at minimizing one's realized income. The fact is that the super-affluent got to that position by being masters at minimizing their realized income. Ross Perot is the perfect example of how the super-affluent stay affluent and even enhance their levels of wealth year after year. Forbes recently estimated that Mr. Perot's net worth was $2.4 billion. See Randall Lane. What's Ross Perot really worth? Forbes, October 19, 1992, page 72. The Citizens for Tax Justice, a tax reform group headquartered in Washington, D.C., estimated that Perot's annual realized income in 1995 was approximately $230 million. Thus, he realized the equivalent of 9.6% of his wealth, but paid only $19.5 million in tax, or 8.5% of his income. See how Perot caps his rising taxes at only 8.5%. Money. January 1994, page 18. Compare this figure with the 31.6% of their income paid in tax by Barbara, Sharon, and many others in their income category. See Table 2, 3. How does Mr. Perot end up paying such a small percentage of his income in tax? According to a recent newspaper report, Perot minimizes his tax bill by investing heavily in tax-free municipals, tax-sheltered real estate, and stocks with unrealized gains. Tom Walker, Perot's tax rate is lower than most, magazine says. Atlanta Journal-Constitution. December 30th, 1993, page 1. Of particular interest, Perot's tax rate as a percentage of his income, that is, 8.5%, is lower than that of the average Amer ican household. The average household in this country pays $4,248 in federal income tax each year, or the equivalent of 12.9% of their annual realized income of $32,823. Perot is super affluent in terms of accumulated wealth, but he is less than the common man's marginal tax liability.